If you were a capital markets person on this call, how do you explain the importance of the Fed doing nothing, and what, if any, influence that might have on mortgage rate and interest rate trends?
Um, there's these varying times when there's more going on than other times, and sometimes the market gets into a rhythm where it's just looking at uh, economic releases that are coming out monthly. Non-farm payrolls is an example, and you're on a trajectory, and the meetings are pretty low impact type meetings. And in that case, the whole landscape of expected inflation, which is we know really drives where mortgage rates are, where treasury rates are, isn't maybe as impacted. But in the recent times, as Ira kind of pointed out earlier, there's so much uncertainty. What's going to happen with tariffs? Are we on the precipice of a recession? So I think these times, more of the investment community is more impacted by what the Fed's doing, what specific things they're how they're approaching it from a policy point of view, whether it's current rate or whether what they're doing with their holdings of treasuries and MBS. So I mean, and I've definitely over the years have taken more of a hands-off kind of perspective. I mean, I think that you just have to wait, let things develop. And when there are more volatile markets, like Ira said earlier, there's just different things you have to do. You have to pay more close to attention to intraday loan sales. You have to adjust pricing more often. You can't pass through full spec payups. There's just things you have to do with more volatility as a sensible capital markets person, just so you don't get caught exposed with faster moving markets.